Hey everybody, welcome into our first segment here on the Mining Stock Daily Long Form episode. Happy to welcome in a returning guest, Mr. Brent Johnson of Santiago Capital. Brent, welcome back to the podcast. I promise you once again we will not talk about mining stocks. Unless you want to.
No. It's all good. All good. Thanks for having me back. Look forward to catching up. I'm going to turn off my email real quick so we don't get a bunch of dings and bells and whistles and stuff when we're talking.
Oh, well, it just shows you how popular you are. There's a number of things we can take this conversation. I want to get a general sense of what is happening in markets, what is happening in the world of macro. I think the story this week, there's multiple stories from this week, but it has been proven that one company can lift the entire tide of boats, and that was NVIDIA. Artificial intelligence really is, you can call it a bubble, you can call it a fad. I don't know where I would describe this, but 30% up in after hours after their quarterly financials, and then the tech stocks continue their rally. It's just reminiscent of 2020, 2021 all over again here, Brent.
Yeah, well, I think there's a bunch of things going on, and they're all kind of intersecting at the same time. And I think, like AI, I mean, there's no question this is a bit of a mania around AI. The thing is that with AI specifically, it's probably a little bit more deserved, in my opinion, than many other fads. I think it actually could be a game changer. I'm not saying it is, but I don't think you can ignore it. I've always said that you have to always be prepared for some emerging technology that you're not ready for to just kind of upend everything. Now, whether AI ends up being that, I don't know, but I think the user adoption rate, the fastest in history, the number of jobs and the number of things that it could disrupt, I think is big enough that you have to pay attention to it. Now, do I think it means that NVIDIA should be up 30% in a day? Probably not, right? And my guess is that we're probably going to see a little backfilling on this big rally that we've seen. So that's part of it. I think the other thing is that when you get into an environment like this and there's not that much growth, I mean, markets for the most part have just been grinding sideways for the last year or 2 years. They've been up, they've been down, they've been up, they've been down. But basically the S&P is right now the same place it was a year ago, same place it was 2 years ago. So when you get into that environment and there's just not a lot of growth around, and you will then get a high concentration where there is growth. In other words, in the one little area where there is growth, people will gravitate to that, and it kind of becomes a self-fulfilling prophecy. So I think we're seeing a little bit of that with technology. The other thing is that technology will typically do better when interest rates are lower. And so the fact that interest rates are still high and they've been rising over the last year, but over the last 6 months, the expectations for them to rise further have started to come down. And so I think that's why you've seen outperformance of the NASDAQ this year over the S&P and the Dow. But if you look at the breadth, there's not that much breadth. In other words, it's all in 5 stocks, right? 5 or 6 stocks. And so to me, that's not the sign of a super healthy market. And then you throw on top of that we've got this debt ceiling debate hanging out there, and everybody's waiting for clarity on that. And then you have the fact that not only do we have the debt ceiling out there, but they've raised rates dramatically over the last year. And I think not everybody, a lot of people are saying that is going to prove, once those rate hikes start to actually get priced into the real economy, that's going to be bad as loans come due and things have to get refinanced at these now higher rates. It's going to be a dramatic, drag on the economy, and we're going to see a pullback, recession, however you want to define that. And so the way I kind of, an analogy I've kind of started using is, imagine you go skiing and it's a beautiful day for skiing, and it's 5 inches of powder, and it's fantastic. However, you can see at the top of the mountain that all of this snow has built up, and it's just going to take one little breath of wind for all that snow to come rushing down the mountain in an avalanche, right? And it's not that just one or two people see this. Like literally everybody sees this massive snow on top of the mountain that's just waiting to come crashing down, but it hasn't come crashing down yet. And so the fact that everybody sees it, a lot of people aren't out skiing. They can see it there, so they don't want to go ski. But those who are skiing are having a great time because the crash hasn't come, the avalanche hasn't happened yet. And so that I kind of equate those to the NASDAQ people, right? The NASDAQ people, the people that are buying the FANGs and the NVIDIAs, and they've had a lot of fun over the last 2 or 3 weeks, even a couple months. But you can't, in my opinion, you can have a lot of fun in this environment, but the problem is that you are taking a lot of risk to have that fun, and at some point that avalanche is going to come down the hill, and that's kind of where I feel like we're at. So we've been very cautious over the last couple of months, and I plan to stay cautious over the next couple of months. It's not that I don't recognize that there's not opportunities. It's not that I don't see that AI could be a game changer, but I'm just not, I'm certainly not going all in on it. And the exposure that we do have is basically hedged at this point, because I think the next couple of months is going to be a lot more volatile than the last couple of months.
You basically just summarized all the bullet point items that I wanted to ask you about, Brent. I wanted to ask you about the debt ceiling. I wanted to ask you about these rate hikes and where we're at with this. Where is the recession? I also want to ask you more about this AI, and maybe let's stick with AI because obviously that's the topic at hand. One thing that we haven't seen is this rush of new SPACs in AI. Yeah. It almost kind of feels, it's similar to the case, obviously I always equate this story to, Ford comes out with the Model T, but it was the oil producers that made the most money. So it's not like the technology companies, they're doing well with AI, but it's the things driving the AI, the chip manufacturers that are really getting massive bid. And I think that's maybe an equatable analogy to make here. But it also has gotten so frothy in the last couple weeks. It's hard for me not to look back and think about all the experiences of the last 3 years and be like, man, this bubble is still blowing up. They're trying to find something to put into it. Yeah.
Well, and that's the thing. And that's why, to be honest, I'm struggling with this a little bit because I believe in the AI kind of revolution. I think it is here to stay. Mm-hmm. But chasing it right now today is a little tough for me. So, we have exposure, but not a lot of exposure. And I think that we will get a pullback over the next couple of months. And depending on how big that pullback is and why we get it will determine whether or not, we increase exposure to equities or not. But I just think that in this type of an environment, well, you kind of have to define what your goal is too. I mean, of course, everybody wants to make money. But when I'm talking as a fiduciary manager of other people's money. So I work with a number of high net worth individuals. I manage their personal portfolios. The primary goal for all of these people is to protect. The first and primary goal is to protect what we have. Let's not have a big correction. Let's not lose a bunch of money. So that's the primary goal. Secondary goal is let's make as much as we can, but within the risk parameters that we've set, right? And so, if your goal is to become the richest man in the world and you don't mind taking a lot of risks in order to do that, well, then you should probably be in NVIDIA and some of these, crypto exchanges and all this other kind of stuff. But, that's not my primary objective. And so I know that in this type of an environment, in this kind of a quote unquote mania, you can make a lot of money. The problem is you can also lose a lot of money. And so I've been through this enough times. I started my career in the late 90s. So I've seen the dot-com bust. I've seen the real estate, bust. I've seen the global financial crisis. I saw the Euro crisis in Europe. We saw the COVID crisis. I've seen these things happen before, and they typically don't end well. And so, I just think we're and then we've, as you mentioned, we got the debt ceiling coming up, right? To me, there's just a heightened possibility for a really bad outcome. So I am being prudent as opposed to being super aggressive right now.
And that risk in the debt ceiling is getting heightened almost every hour now, Brent. There's no resolution in sight. In fact, I did see that the White House was challenged a little bit as to President Biden going to Camp David in Delaware on the holiday weekend. Listen, June 1st, that date that Janet Yellen has engraved in our minds, is 6 days away, and half of those days is a long holiday weekend.
Right.
I don't know what the Vegas odds are like right now for us to default on June 1st, but I would assume that they're getting higher and higher every hour.
Yeah, I guess the way you would bet on it is the credit default swap for the United States, and it's trading about as high as it's ever traded before. So, people are certainly worried about it. Here's the interesting thing for me when it comes to the debt ceiling. On the one hand, I'm not really worried about it because, in my opinion, it will get resolved. However, it's a big enough issue that you can't ignore it. Again, it's kind of like that avalanche up on the hill, or that the potential for the avalanche up on the hill. And so the interesting thing with the debt ceiling is that, in my opinion, other than the initial pop that we would probably get from just them announcing it. So in other words, if they come out in the next couple hours and say, we have reached a deal, I would expect equity markets to rally, risk markets to rally, right? Or if that happens next week. Although upon the initial announcement, I think that would probably be likely. However, the interesting thing to me is that regardless of whether they raise it or they don't raise it, it should be a net drain on liquidity. And what I mean by that is, okay, so let's take both scenarios. Let's pretend that they don't come to a resolution and they don't raise it and the U.S. has a technical default. First of all, I don't think that would last more than a day or two, but let's say it lasts a week, right? Okay. So in that week, the people that own treasuries don't get paid, right? And so they don't get their interest payments. It's very possible that the people that are planning on receiving those interest payments, that's the cash that they were going to use to pay their bills, right? So they don't receive their cash, so then they don't pay their bills, and the people that they owe money to, they don't get paid. So that's net draw on liquidity, lack of liquidity, right? Well, then also all the government vendors, the people that the government pays money to, other than just the treasury holders, they don't get paid. People don't, so the vendors, they don't get paid. The vendors don't get paid. Their employees don't get paid. Employees that don't get paid, they don't make their car payments. So you can get into this massive dollar shortage scenario very quickly if the governments stop paying their bills, right? And so you have to be ready for that. So in that scenario, that would be, you would think that would be a negative for financial markets.
Before you go to the next scenario, is this potentially why we're seeing lack of safe haven assets? The only safe haven asset I'm seeing rising is the dollar. Everything else is falling. I mean, it's ugly.
Yeah. So treasury bonds, so not treasury bonds, but the short-term treasury bills and the dollar are rallying because people want liquidity.
Right.
And treasury bills they're the shortest maturity and they have the best liquidity, other than cash, right?
Okay.
The reason you're probably seeing other things fall, other than the NASDAQ, is for the same reasons, right? Now, and so that you would think that should they have that technical fall, at least for a couple of days, you're going to see the VIX spike. You're probably going to see the dollar spike. Whether longer term treasuries would rally or not, I don't know. I think they probably would, but I don't know for sure. But you'd have a dollar shortage in that instance. When people don't get paid, there's a shortage of dollars. But look, the interesting thing is, if you take the other side of it, let's say that they do raise the debt ceiling. Well, and I think a lot of people say, okay, that's bad for the dollar because now they're taking on more debt. They're never going to be able to pay it off. They're going to have to print more dollars to pay off that debt eventually. That's bad for the dollar. That's correct in kind of the long term. But in the short term, what raising the debt ceiling means is that the Treasury can now go issue more bonds. The reason that's important, okay, is for the last, call it 6 to 9 months, since about November, even though the Fed kept raising rates and the Fed kept doing quantitative tightening, which means they're selling the bonds back to the market. They're draining liquidity from the market. The Fed is. At that same time, Yellen, the Treasury Secretary, so that's the Fed doing the quantitative tightening. Okay, their counterpart at the Treasury, they are still spending money. But because they've bumped up against the debt ceiling kind of in the November timeframe, they are no longer issuing treasury bills or bonds at the same rate that they were. And what that means is that they're spending the government, the Treasury, is spending the money that they have in their TGA account. That stands for the Treasury General. If you ever see the term TGA, it stands for Treasury General Account. It's like your checking account or my checking account. That's the government's checking account. She's been spending that money into the economy. Well, typically what happens is when the government spends money, they're putting money into the economy. That's positive for liquidity. But typically what they're doing at the same time is they're selling treasury bonds. And in exchange for giving the market bonds, they're taking cash back out of the economy. But since we're up against this debt ceiling, they haven't been doing that since, let's just call it November. Okay. So it's been a positive flow of cash into the economy, which has kind of been offsetting everything that Powell's been doing. You may have seen some articles like this over the last 6 months about Powell and Yellen or Treasury and Fed kind of being at odds. This is what they're talking about. So now we get into a scenario where they raise the debt ceiling. Well, 6 or 9 months ago, the TGA, let's just call it 500 billion. Now it's 50 billion. So it's come down a lot. They want to get that back up to 500 billion, a trillion, whatever the number is. I don't know exactly what their goal is, but they definitely want it higher than it is now. So that means they're going to be selling bonds into the market, and they're going to be taking cash out of the market and putting it in their TGA account. So that's a drain on liquidity. So as you drain that liquidity from the market, that means there's going to be less dollars available than there was yesterday. And that's typically a positive for the dollar. And if you look back historically you compare the dollar index to the national debt, typically when we bump up against the debt ceiling and we can no longer issue debt, the dollar goes sideways to down because they're typically providing liquidity. But once the debt ceiling is raised and they start issuing more bonds and start draining that liquidity back into the TGA account, you typically see the dollar will rise. And so that's what I would expect to see again over the summer here, is that if they raise the debt ceiling, although maybe the first couple days or a week is dollar weakness and risk on, I think it's very possible by the time we get to the Fed meeting or later into June and July, we're going to start to see some volatility show up in markets, because I think net it's going to be a negative for liquidity.
Somewhat maybe describe it as a sell the news event.
Yeah, exactly. Yeah, I think if you got a big pop off of the debt ceiling being raised, that would be a sell the news event, in my opinion. Now, all things equal, right? You got to kind of figure out what's the reason they came to an agreement, how long is the agreement, how did they get to it, what else is going on. But just by and large, I think the raising of the debt ceiling is probably a sell the news event.
Yeah. Prior guest this week gave it a 60-40 odd that they'd get this thing resolved, and I said I don't really like those odds. It's not very good.
The funny thing is it's kind of like, you're a gold investor, I'm a gold investor. The reason we own gold, there's many reasons, but one of the main reasons is that when things really blow up, you want that insurance policy, right? And this what we're talking about, like we're talking about basically the system itself kind of coming into question, right? And so even though I think it will be fine, I understand that the consequences of if I'm wrong are big enough that you have to be ready for it. You have to plan for it.
Well, which goes back to, and just I've been scratching my head so much this week. Why is gold just falling so much as this deadline is getting closer and closer? And not that I want you to, pull out your crystal ball, Brent. Why? Is it really the algorithms with the U.S. dollar? As the dollar rise, the algos are just pushing gold down? Is that as simple as that?
I don't think that's not my take on it. So my take on it is that twofold. One is that I think in general, the market, even though they know it's getting up to the deadline, these things typically get resolved. The reality is it doesn't matter whether you're a Democrat or you're a Republican, you want to spend money. If you don't raise this debt ceiling, nobody gets to spend any money. So it's kind of a prisoner's dilemma type thing, right? Everybody wants to get the best deal, but at the same time, they both want to spend money. So they will come to a deal where they can spend money. Now, how much theater plays out between now and then, what the political headlines they get to throw out between now and then, I don't know. But these things typically get resolved because both sides want to get paid or want to be able to spend money. So I think that's part of the reason you don't see gold rallying harder. But the other part of it is that And this is one thing that I often have to talk to the gold investors about, is that typically in a dollar liquidity crunch, a liquidity event where there's a shortage of dollars and it's a risk off event, in those types of events, everything gets sold. It doesn't matter what it is. And gold, since the gold is the most liquid thing in the world, or one of the most liquid things in the world, it typically gets sold in a crisis. I mean, that's your security. That's your insurance policy. When the disaster happens, you sell your security policy and you cash it in, and all that selling then leads to the price going lower. The other thing is that, when you get into that environment, a lot of times gold is traded on margin, right? Majority of gold trading doesn't take place in the physical market. It takes place in the futures market. Futures are done on margin. So when you see the price start to come down, and it starts to go against you, it's leveraged. So you don't have the same, staying power that somebody who just bought physical and put it in a vault somewhere. And so they kind of get forced to sell in that manner. And then the other thing is that, margin clerks in those types of scenarios, they make the decisions, right? It's you don't necessarily sell what you want, you sell what you can. So that's part of it. But then the other part of it is also that if you look in the U.S. has positive real rates. And to me, gold is often a trade on real rates. When real rates are negative, gold is going higher. When real rates are rising, gold is typically going lower. And real rates have been rising with the Fed raising rates as much as they have over the last year, and with inflationary pressures, even though they're still high, they're coming down. You're actually in an environment now where real rates in the U.S. are positive. And I think that it's the only place in the world where real rates are positive. Maybe they are somewhere else and I just haven't seen it. But so I think that's part of it. And again, if you can put your money in a T-bill, which has great liquidity, the government's going to pay you, or at least pay you eventually, right? And it's liquid, or you put it in gold and you have to pay to store gold. Well, the higher the interest rate you get on your T-bill, the more enticing that is. At 0%, you take gold, right? But at 5%, you kind of start thinking about it. Well, I get 5% for sitting in a T-bill. Maybe I don't buy more gold right now. So I think that's part of it as well.
Okay, I want to ask you about interest rates here, because the futures have changed on speculating on if the Fed will raise next month or not. It literally went from close to basically 0% chance from their last meeting to, I think I saw a 30 or 40% chance of another 25 basis point hike in July. It was interesting. It was like a soft pause the other week with Powell up there. Obviously non-committal, as he's been non-committal for the last, 4 or 5 years. But if you observe, and I've had this conversation with a lot of people on the podcast the last couple of weeks here, Brent, if their main objective is to slow down the economy and slow down demand, they're doing a very poor job of it. And I know we can talk about the rise of interest rates needing to trickle into the full economy, and that need to take some time, months perhaps, and then maybe we'll feel the effects of all those rate hikes. But just observationally, I'm looking around, and you might enjoy this. The Nebraska-Colorado football game is like the second most expensive sporting event to buy tickets for right now, including the NBA Finals.
Wow, that is interesting.
Isn't that crazy?
Right?
Yeah, prime time. My wife mentioned to me the other week that Brandi Carlile tickets were going for $800. And I know how much you love Brandi Carlile, Brent, but would you spend $800? I mean, so like all these things are still prickling. Yeah. There is no crush of demand. People are spending all this money that they flush into the system.
Yeah, then that's the thing. And so I think in the same way that, again, I don't know for sure, but I think in the same way that, the Fed thought inflation would be transitory, so they kept the spigots open. And you didn't get inflation, you didn't get inflation, and then all of a sudden you just got a ton of it, right? It's like the ketchup bottle, right? You're trying to get the ketchup out of the bottle and you can't get it out, and then finally it just comes out and it's all over your plate. In the same way that happened with inflation on the way up side, I think we could have it the other way as well. So, the Fed's been raising now. Instead of keeping rates low, they've been raising and raising and raising. And to your point, people still have money. I don't know whether they saved it or whether they're buying everything on credit cards now. They are still, the economy's still moving. And as a result of the economy still moving, the Fed is raising and raising and raising. In the same way that they stood pat and stood pat and stood pat, now they're raising and raising and raising. And we're probably going to get to a point where the economy just hits a wall, and rather than slows down gradually, it has a crash, right? Or some kind of a hard stop. And so I think that's because we've been raising rates for a year now. I think a lot of that stuff, it doesn't show up right away because, as an example, let's say they raised rates in September. Let's say you have a car payment, or you have a business and you have a term loan that resets every 5 years. Now, they've raised rates a lot over the last year, but you've been locked in because you had a 5-year rate, right? But now, you took this loan out in 2019, and now, later this year, it's going to get reset, right? Now your interest payments are going from, 5% to 10%. So the double. And that's when it hits, is when your loan finally comes due and you have to refinance higher. I think there's a lot of that out there, right? In some cases, the wall's not going to get hit until the refinancing takes place. And because the rate hikes have been severe, but they've been in a very short period of time. Like I said, it's really only been a year. So I think as we get into the second half of this year, those rate hikes are going to start to show up across a number of different industries that they just haven't shown up in mass yet. And here's the funny thing about interest rates, raising rates. Until you hit that wall, higher rates are actually sort of stimulative. And what I mean by that is, if you have money in your brokerage account sitting in a money market fund, you're actually getting paid on that now. So more money is showing up in your account, right? If you bought a T-bill 3 years ago and you sat there, you got nothing. But now you get 5%. And there's a lot of, so the government is putting more and more money into the economy in the form of higher interest payments. And as long as the game is still playing, as long as, money is circulating, it's net stimulative. But you will come to a point where everything will stop, and then it's not net stimulative anymore. And then they've got to cut rates. And then, so it's possible we get into a situation where they have to cut just as quickly, or if not quicker, than raising. And I don't know if I actually am of the opinion that it's going to take longer to get there than most people, but I fully acknowledge that it could happen tomorrow.
Ray Dalio put an open-ended note on LinkedIn last week regarding the debt ceiling, and it was pretty interesting because he said basically the thesis of his editorial. And I don't know if you read it or not, but he was right. Whether they come to an agreement or not, there still is a matter of a fact that we're running so much debt. There's going to come a time where the United States government literally just doesn't have the tax revenue to pay for the debt.
Right.
And he actually thinks we're at a tipping point, like now. How do you respond? Do you feel like, similarly as Ray Dalio, are we at a tipping point? And even if they do raise the debt ceiling, we know we're not going to raise taxes because that's a killing. That's going to kill anybody politically.
Yeah.
So it's a double-edged sword here. I mean, is this do you feel like we're on the cusp of a sovereign debt crisis here?
So my thesis for a couple of years now, actually for 4 years now, has been that we're heading into a sovereign debt crisis. And you kind of got to give these monetary authorities and government politicians credit, because their ability to kick the can down the road is really incredible. But I do think we're heading up on this, where I slightly probably disagree with what Dalio is saying. Well, I should say, I actually don't disagree with what he's saying. I do think the U.S. is in trouble, right? It has all these problems. Where I see things a little different than him and some other people who have made these predictions is that the rest of the world is in the same situation. So Canada's in the same situation, Australia's in the same situation, Europe, Japan, China, Australia, South Africa, Brazil, Argentina, Ghana, Ecuador. I mean, the list goes on and on. And because in a weird way, as those economies come into question before the US's economy comes into question and liquidity leaves those countries, I think it will come to the United States. Now, there might not be a lot of liquidity left in those countries, but the little liquidity that there is, I think comes to the US or comes to the US dollar, comes to treasury bonds, comes to treasury bills as a safe haven, a relative safe haven. Again, you got to think in relative terms, and not necessarily a good safe haven, but relative to all the other choices, it's not too bad. And so I think in that scenario, that allows the US to quote unquote get away with these ridiculous policies and these ridiculous debt levels and, spending as a percent of GDP, however you want to measure it. I think it allows the US to quote unquote get away with this for a lot longer than the rest of the world. So while I don't disagree with Dalio and anybody else that says, the chickens are going to come home to roost, I just think for a number of reasons that the U.S. is in a better relative position than the rest of the world. And as a result, you will see all of the dire predictions that people place on the United States. I think you will see them be manifest in other countries before it eventually happens here.
Before we let you go, can I ask you about the commodity complex? I mean, not just precious metals, but in general, the commodities. It's really been a fascinating couple of weeks. I mean, oil is kind of boring. It's been sitting around this mid-70 range. Copper's just fallen through the grave. So Dr. Copper, if you believe Dr. Copper's foreshadowing what's happening with global economies, it's not looking pretty. But we're also kind of into that early springtime where agriculture products from Eastern Europe should be hitting the market. And obviously we still have a war in Ukraine. Watching all these pressures, what is the commodities complex kind of screaming at you right now?
So it's interesting that you bring this up because a week and a half ago, maybe 2 weeks ago, I think it was last week. I finally, after 2 years, started buying some of the grains. We bought wheat, we bought corn, bought soybeans, oats, and not because I necessarily think they're going to rocket higher right away, but for a couple of reasons. One is, unfortunately, I think over the next couple of years, I think it is going to be a more fractured world, not a less fractured world. So unfortunately, I have a pessimistic view of where the world is headed as opposed to an optimistic view. I would love to be wrong, but I don't think I am.
It's hard not to, Brent. It's hard.
Right. And so, and because of all the stuff that we just talked about with the potential for, a dollar shortage or, volatile markets, I have not been as bullish on and I'm actually not bullish on the industrial commodities, so I've stayed away from things like copper and steel and nickel and, some of the other, like you said, the industrial commodity space. But, a couple years ago, a year and a half ago, 2 years ago, the grains made a huge move, right? And, they went parabolic almost, and I missed it. And I was so mad at myself for missing it. But in a similar way that it's hard to go buy NVIDIA right now because it's up 30% in a day, it was very hard for me to go buy corn and wheat, soybeans, because they were up, 100% or whatever it was, in a month or 2 months or 3 months. And so I told myself that I was going to keep watching them, but I was going to be very patient. And I had to wait like a year and a half, right? But, last winter was, for the most part, a pretty mild winter. And I think that's part of the reason why things haven't been as bad in Europe as they otherwise could have been. And, they didn't, and that's why gas prices came down a lot and oil prices came down a lot in Europe. But it also allowed there to be kind of bumper crops around the world. And so far we've had good, what's the right way? Yields on crops the yields on crops this year are looking to be pretty positive. And because of the warm weather, planting got done fairly quickly, and there's a grain deal with the grain from Russia and Ukraine, and They extended that for a couple months, and so that grain is coming to market. And for all of these reasons, the grains have just gotten crushed. I mean, they're down, 30, 40%, in some cases more than that. They're near their they're near their 2 or 3 year low. The relative strength on the charts is horrible. I track some sentiment indices, and the sentiment indices are as low as I've ever seen them. And typically when you buy something with that low of a sentiment, even if you're not right for the long term, you at least get a bounce out of there. So I thought it was time to start buying those. And so I think and then finally, later this year and the next year is an El Nino year. And then in El Nino years, you typically get, let's just call it higher volatility of weather patterns, right? And I have, like, to me, like the last year was kind of a perfect scenario for agricultural commodities. And we're going to have, I think, high crop yields. I have a hard time believing that we're going to have a similar year over the next year. And I think there's a number of factors that could lead to it being much lower, whether it's due to the geopolitical situation in Ukraine, whether it's due to weather, whether it's due to disease or, drought or whatever it is. I think supply could be much lower next year than it is this year. And with demand, people have to eat, right? So it's really hard to crush commodity or, food demand. And so I just think a year from now, prices could be a lot higher in the grains. And so that's why we've started to buy them. I think we're probably a little bit early. They're kind of right where we bought them right now. Maybe they'll go a little bit lower over the summer, but if they do, I plan to buy more.
Could be another wave of inflation if that happens.
Yeah.
All right, Brent, I want to be cognizant of your time. Thanks so much. I really appreciate it. All this insight. It's always a pleasure to chat with you, and I hope you have a wonderful Memorial weekend, long weekend. And I tell you what, when you see that same negative sentiment in the copper and base metal space, will you ring me up?
I will. I'll let you know.
All right. That's Brent Johnson from Santiago Capital, everybody. We're going to take one break and come back with Chris Berry talking about this Ford lithium deal. Stay tuned. Welcome back to our second segment here on our Friday long-form episode on Mining Stock Daily. We're going to turn to the electric vehicle car manufacturing space. Lithium has been obviously a hot topic for, I would say, a number of months now. And so who better to welcome in his day job? He is the man over at House Mountain Partners. And once in a while we get to pull him into Clear Commodity Network to also host the Power Current podcast. None other than the man, Chris Berry. Chris, welcome back to Mining Stock Daily.
Mr. T, it is always a pleasure.
I will say we've gotten a lot of good feedback on your Power Current podcast. Well done.
Thank you, and I have you to thank for a lot of it as the brains behind the front, if you will. But yeah, it's been terrific. I mean, the people that kind of come out of the woodwork that want more information or want to follow up on what have thus far been a pretty random assortment of topics along the battery supply chain has been really interesting. So it's terrific. I'm looking forward to really watching it grow.
Yeah, well, not necessarily random, but there's just a lot to put into it. And so that's really the point of the podcast. And so I would recommend anybody listening, you can find the Power Current with Chris Berry on iTunes podcast and also Spotify. Go hit that subscribe button. A lot of great content that's already been published, more on the way. But the reason, Chris, we got to have you on here is because there was huge news here earlier in the week while Canada was on their holiday. On Monday, Ford announced a just massive lithium supply deal with not just one, not just two. I think there was 3, maybe 4 lithium producers. 5. Geez. Oh my gosh. 5. Okay. 5 to provide lithium supply to their supply chains for a number of years now. Deals included work with Albemarle, SQM, and then also, I mean, let's hear from you. I mean, tell us about this deal and what is it? We can talk about the significance here in a little bit, but give us a sense of the breadth of this deal.
Yeah, look, in some ways, just the number of deals that were announced by Ford in one single day is unprecedented. I mean, usually some of the bigger offtake agreements that we've seen thus far coming from major OEMs, like, for example, General Motors or Tesla, are kind of like, they're one-off deals. And what was interesting about what we heard on Monday was meant to coincide with Ford's Investor Day. And so they have struck, I guess would be the best way to describe it, 5 distinct lithium offtake agreement deals. Obviously, look, there are a lot of pieces of this puzzle that are sort of left out. I mean, we know certain things about tonnage and duration of the contracts for specific players, but for some of them we don't. And that is just the way that, quite frankly, a lot of these deals are negotiated. You're absolutely right. 2 of the 5 are existing producers today, Albemarle and SQM. And that Albemarle deal, interestingly enough, is for a total of 100,000 tons of lithium over the course of the life of the contract, which I think was designed to go from 2026 to 2030. So, look, we can get into a lot of the details here, but suffice to say that Ford is, in some ways, I think, playing catch up or trying to leapfrog some of their competitors in terms of locking in a lot of the supply. I think if there's a challenge here, or maybe a danger, it's that for 3 of the 5 players that they have locked in deals with, they are not in production yet today, and in many cases have limited operating experience. So again, it's just something that might be thought of as a little bit further out there on the risk curve. But these deals really aren't going to kick in until 2025, 2026. And again, I think that really speaks to Ford's view that, look, it's probably a well-supplied, or they think they will be well-supplied with lithium to, say, 2025. And then from 2025 onwards, it's a little bit of a riskier sort of proposition. And so this is them kind of saying, listen, we will show up with the checkbook and enter into these deals and, hope, for lack of a better phrase, that these suppliers can supply enough lithium to help them achieve their goals.
We've heard a number of stories about these car companies coming into a number of mining conferences here. And so that's been a huge theme for the last year. And so I'm wondering how do these OEMs understand the risk profiles of working with not only current metal producers, but the very much higher risk developers here? Because we know, you and I know, Chris, that not everything in mining goes right all the time. In fact, it rarely goes right. And so how is a company like Ford kind of managing that risk when they go out and give money for these offtakes right off the bat before it's even produced? Sure.
Look, I think that Ford doesn't have a choice. And to be fair, neither does General Motors or Tesla or Daimler or any other major Western automotive manufacturer. We're not in a situation where lithium demand is going to grow at 5 or 6% per year anymore. It's going to grow at 20% per year over the course of this decade. That's my personal view. And so the leverage and the pendulum, if you will, has really swung in favor of the lithium miners. So if you're Albemarle or SQM or Livent, yes, you're going to expand capacity aggressively to try to maintain and increase market share, but not to the point where you run the risk of seeing lithium pricing come crashing down. Because of that, the Fords, the major OEMs, even the battery manufacturers have been forced, for lack of a better phrase, to look, to your point, a little bit further down the risk curve, looking at lithium mining companies, or, you could say the same thing about nickel or copper or cobalt players that do not have production experience and are not likely to be in production for the next several years. Again, we're seeing this across almost all the battery metals, but again, lithium is what I like to say, call it as the belle of the ball, right? That is the one that you can make all kinds of different chemistries of lithium ion batteries. You can use less nickel, less cobalt, no cobalt, that type of thing. But you really cannot produce, an optimal battery for mobility applications, cars, trucks, and buses, without lithium. And so that's why you're seeing this huge rush. And hindsight's always 2020. I'm sure if you were to talk to procurement managers at Ford or General Motors or any of these companies, they would have said, yeah, we should have been making these investments 3 or 4 or 5 years ago, because you'd just be that much closer to locking in some of the supply. But that's not the case. And so, as I mentioned before, what we've sort of seen with Ford, their announcement on Monday is basically saying, okay, we're going to try and leapfrog our competition or try and catch up just to make sure that they have adequate supply of lithium in particular. And then, one other thing I would say is this story, not just for Ford, but for other players, goes beyond lithium. You're starting to see OEMs, again, like Ford, enter into investment agreements for nickel. In particular, Ford and a Chinese player called Huayou Cobalt and a group out of Indonesia are working on developing, or have planned, I should say, to develop nickel capacity coming out of Indonesia, which, interestingly enough, is not an IRA compliant provider of the material. So I'll stop there.
We need to open that up, Chris, because the IRA, the Inflation Reduction Act, that was passed, last year, 2 years ago. That act really corners American companies into where they're going to get these materials supplied from. It can only come from the U.S. or U.S. allied countries. And so if you're narrowing down the supply just based on law, and now it's getting narrower just based on these deals, I guess, how tight is supply going to get here? If we just stick with the lithium here, how tight can supply get in the midterm?
Yeah, and the other thing in terms of narrowing supply that I would just add to what you said is there's also this ESG component now, where you can't just go and mine lithium from hard rock sources or from brine sources in the manner in which we all used to be able to do. So the process and the processing for lithium in particular is set to get more narrow, if you will, I think would be the right way to put it. And so, look, the IRA is, and it just with respect to the battery business, it is an incredibly, I think, economically beneficial piece of legislation as it's written. Yes, there are some question marks now around foreign entities of concern and sort of who that is and what that means. I think we all know that that is designed to focus on China and Russia in particular. But, here's the real challenge. One of the real challenges, I think, in terms of how to interpret this law, and again, to your point, how to get the OEMs to benefit from it. So the IRA basically says that in order to access the total of the $7,500 tax credits, the raw materials, a certain percentage of the raw materials have to either be mined, refined, or recycled in North America or from a free trade country. The recycling is just North America, but actual processing and extraction of the minerals can also come from the free trade partner, okay? The U.S. has 20 free trade agreements in place today, and only 5 of those agreements or 5 of those countries have anything to do of any significant size with the battery metals market, right? It's Canada, Mexico, Chile, Australia, and South Korea. So those are major players, which is the good news. But, just sort of dovetailing with our nickel conversation a minute ago, Indonesia does not have a free trade agreement in place with the United States. And so what you are likely to see happen, I think, going forward is countries that are blessed with these natural resources, whether or not it's lithium or nickel or what have you, but we do not have a free trade agreement in place with, you're likely to see sort of a subsequent agreement, if you will, not a full piece of legislation like a new IRA, but as an example, the United States and Japan have effectively agreed to honor the spirit of the IRA, despite the fact that the United States and Japan do not have a free trade agreement in place. So you're going to see, in my opinion, you'll see that happen with Indonesia. You'll see that happen with Argentina as well, in particular, another ally of ours that would be, a perfect source of lithium that we don't have a free trade agreement in place with. So you're going to see the IRA, I think, the interpretation of the IRA and where these minerals come from evolve. But again, it's unlikely that the foreign entity of concern designation is going to change, and that really is going to center on China.
It's kind of a left curveball question here, Chris, but is this at all reducing inflation? I mean, it sounds like this kind of deal actually makes it a little bit tougher to.
Yeah, no, that the Inflation Reduction Act is not appropriately or accurately named, in my opinion. I think, and I would have said that even before the IRA came into being. I mean, anytime to your point, shrink supply, or even try and shrink supply lines, you shrink the number of suppliers that you can utilize and leverage to lower your costs. It stands to reason that your cost structure will either stagnate or arguably increase. And so, it'll either be technology that saves the day to try and manage or lower costs, or somehow, we figure out a way to extract and process raw materials at a lower cost. But it's really challenging. I would not say the IRA will reduce costs anytime soon, if ever.
Okay. Well, thank you for that honesty. Where does this stop? We obviously, this is happening in the lithium space, big deals being done. You mentioned nickel. I mean, could we see something like this happen in the copper space? I mean, that's a much bigger product for manufacturing, not just electric vehicles, obviously, but could we see something like this being expanded into the other resources, maybe into like manganese or tungsten or the like?
I think a lot of it depends on pricing volatility in the market. Lithium, the spot price in lithium in October of 2020 in China was around $6,000 a ton. It went to 85, then came way back down to 22. Today is at 35 or 40. That's the number that gets all the press. The bottom line is those contract prices are slightly higher, but we saw insane pricing volatility in lithium. You saw insane pricing volatility in nickel last year, partially because of shenanigans on the LME. But part of that, I think, was demand driven, at least. And so, look, if we get into a situation where you have $10,000 or $15,000 per ton copper, and that similar volatility that we saw in these other metals feeds into copper or molybdenum or tungsten, you will see automakers and you will see governments get more involved. We haven't really seen it yet because I think, to your point, everyone's expecting copper to explode higher. I mean, I can't find the other side of that trade. Everyone thinks we're going to $10,000, $15,000 copper in the next couple of years. And I'm certainly bullish on it as well, but I don't think you're going to see, I'll just make up a General Motors or a Ford, do a multi-$100 million deal for copper supply until you see the volatility start to affect their ability to access the raw materials and also pay a lower price.
Yeah. What does a demand crunch do for EVs here? What if we're waiting for this recession to hit here, Chris? Any day, look, we've been told.
This is a challenge. The average electric vehicle, I think, here in the United States, the last data I saw, which admittedly was a few months ago, the average EV has a price tag of around $66,000 a ton per EV. Okay,
right.
That is not a car that is really affordable to the mass market, right? And this is what we're all trying to do. I mean, Tesla's always talked about the $35,000 Model 3, and they're not able to get there, even, I think, necessarily with the subsidies. Although, to be fair, it probably takes a little bit more digging to confirm that. The price of the EV has to come down, even without the subsidies. And the price of the EV comes down when you lower the price of the battery, which is 30% of the cost of the EV. And you do that by accessing cheaper raw materials. Okay. And again, depending upon your battery chemistry and depending upon, when you struck these deals, it's going to be pretty difficult, honestly, to lower the battery cost anytime in the next couple of years. Certainly if lithium stays elevated, which I think it will, and you start to see some pricing volatility in some of these other metals. So, it's a real challenge. And then, the other issue with the Inflation Reduction Act is everyone's so focused on these tax credits, excuse me, and they should be because they are beneficial, but there are also income levels now associated with accessing these tax credits. So if I have an adjusted gross income as a single individual, of 150,000 US dollars a ton. Or, I keep saying per ton. Wow.
It's been a long week. You've had a long week.
Is it? What day is it? Wednesday. $150,000 per year in terms of salary. If I make $1 over that number, I'm not eligible for those tax credits. It doesn't matter what the price of the car is, and there are other nuances for filing jointly and all that kind of stuff. So the bottom line is, look, it's going to be difficult. I think the IRA is going to benefit miners, refiners, and recyclers first. Okay. Mm-hmm. Also, it will benefit cathode and anode manufacturing because of some of the benefits of the IRA away from the tax credits. They have nothing to do with that, but just tax credits on your OPEX and all that kind of stuff. It's very, very beneficial, I would argue, to produce batteries here in the United States. And so it's going to become a scale game, and hopefully through scale, even with elevated metals prices, that is how you ultimately lower the cost of these EVs and make it affordable to the masses. But this is not an overnight thing. This is going to take a while.
Right. All right. Chris, thanks so much for your time. Happy we could wrap up the week here with you. Go over to House Mountain Partners to find Chris and his work. Also, go check out The Power Current with Chris Berry, because it's a great podcast. I'm happy we could get this thing launched. And if you like this conversation, man, you're going to love everything he's been putting out. Chris, have yourself a great long holiday weekend, and all the best to you and the family.
Will do.